Imagine this for a moment. It is a quiet Tuesday morning. You are sitting at your kitchen table with a cup of coffee. The mail just arrived. You open a plain white envelope from the IRS, and your stomach drops. The letter says you owe thousands of dollars in back taxes on your Social Security benefits, taxes you were told you would not have to pay, taxes you thought were eliminated by the new law you heard about on the news last summer. Your hands start to shake. You think to yourself, how is this possible? I followed the rules. I am a retired American. I worked my whole life. I paid into the system. And now this? If that scenario makes your heart race even a little, please stay with me. Because what I am about to share could save you tens of thousands of dollars over the next 4 years. My name is Artur. I am a senior policy analyst, and I have spent years helping retirees just like you understand the complicated rules that quietly drain retirement savings. Today, I am going to walk you through one of the most misunderstood tax changes in modern history, a change that has a ticking clock on it, a clock that runs out on December 31st, 2028. That gives you and me a window of roughly 18 months of serious planning time before the real damage begins for millions of seniors who are not paying attention. And please, stay with me until the very end of this video, because there is one hidden mistake that I see retirees make over and over again. A mistake so small it looks innocent. But it can wipe out up to $48,000 in tax benefits for a married couple. I will reveal it before we finish. Let me tell you about Robert. Robert is 67 years old. He lives in a modest home in Ohio. He retired 3 years ago from a manufacturing job he held for 35 years. His wife, Linda, is 66. They live on Social Security, a small pension, and careful withdrawals from a modest IRA. In July of 2025, Robert was watching the evening news. He heard a headline that made him smile for the first time in months. The newscaster said the new One Big Beautiful Bill Act had just been signed into law, and Robert thought he heard the most beautiful words a retiree can hear, that taxes on Social Security benefits were being eliminated. Robert was so excited he called his wife into the living room. They hugged. They felt relief for the first time in years. The next morning, Robert did something that seemed perfectly reasonable. He went online and adjusted his tax withholding. He stopped the voluntary federal withholding on his Social Security check. He figured, why give the government money they are not going to tax anyway? Then he made one more decision. He and Linda had been filing their taxes jointly for 41 years, but their accountant had once mentioned that filing separately might lower their Medicare premiums, so Robert decided this might be the year to try it. After all, taxes on Social Security were gone. What did they have to lose? Friends. Robert lost almost everything he was supposed to gain. Let me explain exactly what happened and why this could happen to you too if you are not careful. Here is the truth about the One Big Beautiful Bill Act, straight from official IRS fact sheet FS-2025-03, dated July 14, 2025. The new law did not eliminate taxes on Social Security benefits. I want to repeat that, because it is the single biggest misunderstanding in retirement America right now. The law did not eliminate taxes on Social Security. In fact, the Social Security Administration itself had to issue a corrected press release on July 3, 2025, walking back earlier language that had confused millions of seniors. What the law actually did was create a brand new temporary deduction. It is called the Senior Bonus Deduction, and here is how it works. If you are 65 or older, you can claim an extra $6,000 deduction on your federal tax return. If you are married and both of you are 65 or older, you can claim $12,000 together. You can take this deduction whether you use the standard deduction or you itemize. It stacks on top of the regular standard deduction. It stacks on top of the existing extra deduction for people over 65. For a single senior in 2025, all three deductions combined can total up to $23,750. For a qualifying couple, up to $46,700. That is a real, meaningful tax break. But here is the part the news headlines did not shout from the rooftops. This deduction is only available for 4 tax years, 2025, 2026, 2027, and 2028. That is it. After December 31st, 2028, the $6,000 senior bonus deduction disappears. Gone. Unless Congress acts to extend it, which is not guaranteed. And here is where the tax bomb really detonates. When that deduction goes away in 2029, millions of seniors who currently pay little or no tax on their Social Security benefits will suddenly see up to 85% of those benefits become taxable again. The provisional income thresholds have not changed. They are still $25,000 for a single filer and $32,000 for a married couple filing jointly. Those numbers have been frozen for decades, and they will quietly snap back into place the moment this deduction expires. There is more you need to know. The deduction phases out for higher incomes. If you are single and your modified adjusted gross income goes above $75,000, you start losing the deduction at a rate of 6 cents per dollar. By the time you hit $175,000, the deduction is completely gone. For married couples filing jointly, the phase-out starts at $150,000 and ends at $250,000. This is critical because one large withdrawal from your IRA, one Roth conversion, one capital gain from selling stock or property, one required minimum distribution, any of these can push you over the edge in a single year. Now back to Robert. Robert stopped his Social Security withholding because he thought benefits were tax-free. They were not. By the time tax season arrived, he owed thousands in unpaid federal tax, plus an underpayment penalty under Internal Revenue Code, Section 6654, calculated at the federal short-term rate plus 3 percentage points. Then there was the filing separately decision. Under the new law, married seniors must file jointly to claim the senior bonus deduction. By filing separately, Robert and Linda forfeited the entire $12,000 deduction, not a portion, the entire amount. And it gets worse. 2 years later, because their separately filed returns showed higher individual incomes, they were hit with IRMAA surcharges on their Medicare Part B and Part D premiums. Several hundred extra dollars per month per person because of the 2-year look-back rule from the Social Security Administration. One innocent-sounding decision, one headline misunderstood, tens of thousands of dollars in damage. I do not want this to be your story. So let me give you 3 exact actions you can take, starting this week, to protect yourself. Step 1. Verify your eligibility and claim the deduction correctly every single year from 2025 through 2028. Go to irs.gov and search for Fact Sheet, FS-2025-03. Read it yourself. Do not rely on what your neighbor said or what someone posted on Facebook, or even what a newscaster said in passing. If you are 65 or older by December 31st of the tax year and your income falls within the limits, you qualify. Make sure your tax preparer is claiming this deduction on your Form 1040. If you prepare your own taxes, double-check the line. And if you need free help, the AARP Tax Aid Program offers IRS Certified, no-cost tax preparation for taxpayers age 50 and older. Use it. Step 2. If you are married, file jointly. Period. I know some couples file separately for various reasons. State tax planning, Medicare strategies, income-based repayment plans. But starting in tax year 2025 and running through 2028, filing separately costs you the entire senior bonus deduction. That is up to $12,000 per year, up to $48,000 across 4 years. Before you change your filing status, talk to a qualified tax professional or use the IRS Interactive Tax Assistant at irs.gov to model both scenarios. Step 3. Plan for the 2029 cliff right now. Today. Do not wait. The deduction expires on December 31st, 2028. That means tax year 2029 is when the bomb goes off. If you stopped or reduced your Social Security withholding, restart it now using IRS Form W-4V. You can elect 7%, 10%, 12%, or 22%. If you take large withdrawals from retirement accounts, file IRS Form 1040-ES and make quarterly estimated payments to avoid underpayment penalties. And if a one-time event like a Roth conversion or a property sale, spikes your income and triggers higher Medicare premiums. File SSA Form SSA-44 to request relief under the life-changing event rules. These 3 steps are not complicated, but they require you to act, not assume. Now, that hidden mistake I promised to reveal at the end. The mistake is not Robert stopping his withholding. It is not filing separately. Those are the visible mistakes. The hidden mistake, the one that quietly destroys retirement plans, is this: treating the senior bonus deduction as permanent. Across the country, retirees right now are restructuring their entire retirement income strategy based on the assumption that this $6,000 deduction will always be there. They are taking larger IRA withdrawals. They are doing big Roth conversions. They are buying homes or cars based on what their taxable income looks like today. But this deduction has a death date: December 31st, 2028. And the moment it expires, every plan built on it collapses. Suddenly, your provisional income matters again. Suddenly, your Social Security is taxable again. Suddenly, you owe IRMAA surcharges you never owed before. Suddenly, your retirement budget is wrong by $10,000, $20,000, $30,000 a year. You have roughly 18 months of meaningful planning time to prepare, to smooth out your income, to prepay taxes, to time your conversions, to restructure your withdrawals, to protect yourself. Please do not waste this window. And here is my final, most important message to you. Do not rely only on YouTube notifications for critical updates about your retirement. YouTube notifications fail. Algorithms change. Videos get buried. The rules I just described are the law of the land today, but Congress can change them, extend them, or let them expire. You must check official sources directly. Bookmark irs.gov, bookmark ssa.gov, bookmark aarp.org. Visit them yourself every few months. Sign up for official email updates from the Social Security Administration. Read the actual fact sheets when new laws are passed. Your retirement is too important to leave in the hands of headlines. If this video helped you understand the senior bonus deduction and the 2029 tax cliff, please share it with another retiree who needs to hear it: a neighbor, a friend at church, a sibling, someone who, like Robert, might be one innocent decision away from losing thousands of dollars they cannot afford to lose. Subscribe to Senior Pension Benefits Hub and turn on the bell so you do not miss the next update. But more importantly, take action this week. You have 18 months. The clock is ticking. I am Artur. Thank you for trusting me with your time today. Stay informed, stay protected, and I will see you in the next video.